Hello, everyone. How's everyone doing? Paul, Hugo, who was it? Richard, be glad that you're just dying to hear what people say instead of being in the in the fray. So, okay. Let's take a look around. Well, there we go. You know, I wanted to see a new high in the dollar, but I was hoping it was going to be Fed policy rather than a tragic war with a lot of people dying. One thing I do want to show is that the ruble has come off quite a bit from its spike high. This is a new all-time high in ruble. You could go back to the monthly, which means it's a new all-time low in the ruble.
Good morning, Dale.
Hey, how are you?
Good early morning. We are seeing your trader funding program.
Oh, okay. Here. Thanks very much,
K-Man.
Yeah.
Charts already.
How about now?
That's much better.
Okay, so there's a ruble.
Look at you just trying to promote the trader funding program.
That's intentionally, really nice. That's the best part.
It was an accident. It's the only banner I have to start the webinar because Steve is what's going to send it to me. But he said, wait till the hostilities start in Russia and I'll get that banner to you. So, anyway,
right. We'll let you continue.
All right. So, you know, dollar's not that far away from a new high, and you know, everything's related to what happened. You know, we finally got that break in the euro under this 1280 level. It measures 1050 to that long-term trend line coming in here. This is the one. This is monthly chart down around this, you know, 110 level, 110 and a half. So looks like that's a layup from here. You know, we could get there today, but this wick in ruble might be the first indication that maybe we get some wicks and other things, like a little wick in silver. I'm not saying that you faded today, but you know, if you've been fortunate to be long these and the miners, nothing wrong with using a major event like this to take something off. Because there are times, and the ruble might be a tell, that sometimes the beginning of hostilities could be, you know, the buy of the rumor, sell the fact on a very, very, very major level. So everything that should be moving based upon this is everyone going to the dollar, to the metals. You know, 4120 was a number I talked about in S&Ps to complete this. If this was a 4, now this could be completing something here. So, you know, don't just blow out your 401k here now. Okay. And it's interesting, guys. You know, I got a call from my sister yesterday. She's got all her money in her 401k, and she was only down 6%. And she says, I'm losing money. I said, you're giving back profits. You've been in for the last 5 years, and the last or longer, in the last 3 years were the best performing years, 3 years in market history. So, I mean, people are already nervous just giving back a little profits. So Putin is helping Powell out by causing some fear. So now, what do you think? Now people are saying because of this, Powell won't do anything, but it's still a long time till that meeting, and you could have recoveries and things settle down by the Fed meeting. What do you think?
So the first thing about this ruble is that Central Bank of Russia has been apparently
they're intervening.
It's trying to regulate the dollar ruble a bit. They have a pretty big reserves. So
yes, they do.
I guess they can cap things for a while at least.
Yeah, it's close to it. I heard like it's been his rainy day funds almost $1 trillion. I think 800 billion.
Yeah.
Keep the oligarchs happy.
Yeah.
Right. Pay them off during this.
Right, and then And then regarding the euro, of course, I mean, it's risk off, it's close to Europe's door. But in addition to that, ECB commentators and a couple of people from the ECB have already said that they would continue to the bond buying program until at least end 2022, possibly into 2023. So besides all the geopolitical stuff, it's ECB themselves who have been putting additional pressure on the euro this morning.
But by the way, Cayman, the fun part is that comes out of the mouth of the people that work for a central bank that has a single mandate, and that's price stability.
Yeah.
That's the funniest part of all, right? ECB has one mandate.
Yep.
Price stability.
So they're keeping it stable. They keep on
I mean, at least the Fed on occasion can claim the joke that they have another mandate, which is employment. ECB has a single mandate. So what does that make them when inflation keeps exploding higher, and they're still putting gasoline in the fire? How exactly can they claim they're not completely incompetent?
That's true. And now the inflation is even going to spike higher because
of course, natural gas, crude oil,
and even the base providers for foodstuff like wheat and things like that. So I mean, it's
the fun part is that people don't realize, and I'm afraid the Fed might end up doing that mistake, at least partially, right? I mean, I see many commentators. It's amazing. I mean, the media are now full of people that really don't understand basic economics. I would send these people back not to university, to elementary school, because it's not understanding basic maths as well. Many people don't understand that war has nothing to do with the mandate of any central bank. I don't know a single central bank in the world that has a mandate that has anything to do with geopolitical issues, right? I mean, all of them have price stability. Some of them might have, like, let's say, employment, like the Fed. So the question is, these geopolitical developments, can they act as a disinflationary force or as an extra inflationary force? The answer is obvious, right? Inflationary. So theoretically speaking, if these people want to do their work, right, if there was to be any change of response from central banks to what is currently happening in the geopolitical sphere, it should be get more aggressive in hiking than anything else.
Yeah, but that's not going to happen. That's
we all know that it's gone now. Yeah, the single mandates of the central banks.
It's a stock market.
And those who are now the new self-proclaimed economists, they are now self-proclaimed war strategists. They were like the self-proclaimed virologists during the pandemic. So there's the same people, right?
Yeah. I totally agree.
So, speaking of which, and good morning, guys. You talk about what Steve is saying. I mean, ironically, what the Fed should be doing is raising rates into this, but then at the same time, you have to ask yourself what central banks are asking themselves right now. Do you fight inflation or do you fight a slowing economy due to whatever other factors? And that's what they're going to be faced with. And this is the market. Well, let me get over to the dollar index. I would say this is the dollar index right now calling out the Fed, saying you are not going to try to slow down the economy. You are not going to try to fight inflation. We're going to call your bluff. And the dollar index is actually rallying probably for a few different reasons. Not just that, obviously, but that's reflective of the market saying, yeah, the Fed's not going to do anything right now. And we want to pick up dollars as a risk aversion type of tool, because we have the NASDAQ 100, which I haven't even gone over the composite, but you got the NASDAQ 100 that's now down 22% off of the highs, right? So now you got a situation where, and if anybody that listens to our webinars, the ForexAnalytix webinars that we do on a daily basis, know my feeling that once the equity markets get down to about down 20% or so, that's when you start to really worry and get dollar bulls coming out. This is where the dollar picks up the risk aversion mantle, if you will, the hedge of a risk aversion tool, and that's what we're seeing in the dollar index. What do you guys think about what to do with the dollar here? Because we are seeing the dollar race up, getting towards the 2022 highs. What do you guys think? Are you
98?
Steve, are you a dollar bull or bear right now?
I've said it before. As long as multiple times, as long as dollar trades above 94.50, there is no reason to be bearish.
Okay,
right?
So you're buying dollars. Okay, K-Man, are you a dollar bear or bull right now?
I'm going to be buying.
Come on, it's a yes or no question.
I'm going to be buying
It's
dollars
easy.
on dips because the situation is just too fluid right now. But I'm still
fluid and
I'm still overall
risky,
more bullish than bearish dollars. I'm leaning towards the bullish side.
Yeah, and you know, I mean that's look, it's a hard question. It's not easy as like yes or no. But honestly, it really comes down to the Russia-Ukraine situation, what happens from here. I mean, right now, and I've been doing some reading and a little bit, and I had some research pieces that were saying this is very similar to what Russia did in Georgia back in 2008. You know, and as far as Ukraine goes, there
wasn't even a hiccup in our markets back then.
Well, yeah, and but the thing is one of the things that what's happening right now is that you look at what's happening with Ukraine. This is like Russia's not their intention, from what it seems like, is not to actually invade or occupy Ukraine. It's actually they're doing precision military strikes on Ukraine right now, and weakening them from a militaristic standpoint. So if Russia at any moment, Russia could back away, and within a couple of days we could be back to more of a okay, now what happens type of situation. But as of right now, in the heat of the moment, people are buying dollars, and that's the fact, right? I have to point out a couple of things that are some pretty big moves here just regarding the dollar index, and just going through the dollar pairs. Like you look at the euro dollar is approaching that major trend line down here, and I've been a buyer down here. Yesterday I was scalping around. Last night I bought the euro, I think at like, I don't know, 112.20 or 112.20 and sold it at like 112.35 or something like that before I went to bed. And even though I have some euro exposure, cross rate exposure, I'm pretty well hedged. When you get up after a night like this, and I was telling the chat room, when I get up after a night like this and my P&L is actually slightly positive, that means I'm hedged really well or prepared for a big bounce. I haven't figured that one out just yet, but you notice that the euro is down at some pretty key levels of support. Now, this is big because technically, we've noted this chart 1,000 times on this webinar. This is a multi-decade trend line break, and I've played the bounce here so many times, and I'm not immune to doing it again. Given the circumstances, you have to, obviously keep in mind what's happening. So keep your position sizes small. But I'm going to say that this 111s, let's just say roughly, is a pretty big support. The cable just actually hit the 161% extension of the range that we've been in for literally all month, the whole month of February. It was so boring with the sterling, and finally just broke lower, following, last night's move. Australia, this was rallying just perfectly fine. We did a look at this, just so you guys can see this in the dotted red line. Okay. Measured move, measured move, measured move. I mean, perfect measured moves. Obviously the timing's kind of uncanny, but you're seeing obviously the Aussies coming off as a result, as the dollar picks up steam. Kiwi too. The Kiwi was doing just fine. And I got to say something about the New Zealand dollar. K-Man, you could probably confirm this as well. Every time the New Zealand dollar gets some sort of tailwind from a central bank, whether it's like a hawkish hike, what we got the other night, or it's an interest rate decision or jobs report. I've noticed this with the New Zealand dollar like forever. the day after move is usually a big reversal, and
That's true.
a lot of times doesn't have anything to do with what happened the other night.
Of course, it has to do with risk today.
Yeah, today has to do with risk.
But it is true, and one of the reasons why it's sometimes so difficult as well to trade the Kiwi as such is that it's still a low liquidity market. It's a small market compared to others, even compared to the Aussie. I don't know how much bigger the Aussie is, but then go compare it to euro or the dollar or the sterling markets or the yen markets. It's relatively small, right? So when people step in and out to take profits or to put on positions, Kiwi tends to be a really good mover, as we have seen into and on the RB and Z. But then it's mostly the case that people, the money managers, take a bit of money off the table, take their profits, and the Kiwi moves fast the other way around as well.
Yeah, it's wild. Anyway, you got a big reversal in the Kiwi. The dollar Canadian actually finally popped above 128, but really very limited upside here with the Canadian, and that is.
How about the yen only being US dollar yen only being down 5 in this?
Yeah, and I was just going to make my way there, but I got to say regarding the Canadian, I mean, dude, with crude oil at 100 right now, that's one of the reasons why the Canadian is just not moving. You know what I mean? It doesn't want to budge, because you got an opposite force of its tailwind of crude oil. Then and Dale, you're right. I actually bought dollar yen yesterday. No, 2 days ago, right at the same level we're at 114.90, and I played this, and I actually played it yesterday for like a 20 pip bounce yesterday. I keep buying this thing, but I don't understand why the dollar yen is not weaker. But that's why I want to hear from K-Man. What do you say, Mr.?
That is the same reason as in Canadian dollar, because the energy prices are shooting up. So they have to pay up bigger amounts to buy their energy, which is expressed in dollars. So it's those opposite pulling forces about risk and energy prices.
Right. Okay. And I mean, because that really is a big headwind for the Japanese economy, right? They have to continue to bring in their energy, because last I looked, Japan doesn't have a lot of resources, right?
No, they are importing most. And the thing is as well, that's why you see the dollar yen as such staying relatively stable, but then the yen crosses are going down. So
spending 6 months of my life on Japan as well. I don't know. In Japan as well, K-Man. I don't know. I feel bad for Japan in that respect. They really are reliant on the rest of the world. It's amazing that they could.
They're trying to diminish it. They are now planning, but it takes years to put the nuclear plants back online. Then they have LNG projects left, right, and center. But it all takes so much time to come online and to really be productive.
Right.
But there's one interesting thing though that I need to mention regarding the yen is that during the night when things started to heat up, there were some comments about Kuroda, from Kuroda and Suzuki, the finance minister.
Yeah, you were posting in the chat room a bunch of headlines from the Bank of Japan. So please go on.
There's this one or two lines which prevents me from really going short yen right now, is that they both were saying something about a weaker yen is only going to increase our energy costs. And I was saying that, well, that's a couple of lines who really make me think about, do they say that the weakness of the yen is enough right now? Or is it just because besides that, Kuroda was still saying they will continue to ease. So the Bank of Japan will be easing into eternity. But about the yen level as such, I'm not sure I want to be really short yen, barring a risk spike after the Ukraine situation, perhaps.
Okay, well, thank you very much for those comments. I really appreciate it. I know everybody else here listening in really does appreciate it too. Let's really fast. Let me reference gold, because Kareem actually brought up gold. Gold has ripped higher. And this is a conversation we were having on the daily roundup yesterday. I said, hey, look, gold, you guys be looking at this big double bottom, this big breakout. And we were yesterday, we were not broken out yet. We were right up against 1915. And I think it was yesterday I said, hey, you know, we're just really one headline away from us breaking out here. Oh no, that was for the S&P breaking down, which ended up being correct. But as a result, actually gold broke out, and we were talking about the W formation and the double bottom extension of gold, which can now take us to 2100. Now, 2100 or 2150, let's just say 2158 is actually what it comes out to, but it just call it 2150. That would be the double. Sorry, damn it! I keep hitting the wrong button. Hold on, let me get back. There we go. Okay, so this right here, double bottom, extends out to 2150. Now, 2150. If you really want to take a look at a longer term chart, go over to a weekly chart, zoom out. Or zoom in rather, and see the channel that would be developed from the high in 2011, the high in 2020, the low in 2015, roughly you could say, you know, low 2015, low 2018. That takes us to 2150, which would, you know, be a measured move to new highs and then probably fail up there. That doesn't mean that gold's bearish. That just means like what you saw in 2020. You saw a spike to new highs and then it eased off. And it's long-term, decade long-term quest for 3,000 eventually. I mean, you know, I'm not going to sit here and say we're going to hit 3,000 the next week. No, but if you look at the overall trend, probably over the next 10 years, you know, we're going to, you know, make our way up towards maybe 2,500 or maybe whatever, you know, you guys can, you know, try to guesstimate what it might be. But overall, we're trending higher. And if we hit new highs, you know, I might actually sell my physical gold into new all-time highs there. And I'm not kidding. Actually, if you guys were listening to this webinar or the Morning Edge, and we were just talking about this yesterday, if you're listening to the Morning Edge webinar back in 2013, right around here, is when we had, or maybe it was like right here. I can't remember. It's one of these two where we broke down pretty aggressively. I sold all my physical gold back then, and then rebought everything, you know, a few years ago. I'm probably going to be doing that again, realistically this time around. So that's kind of what I'm, you know, we were talking about this yesterday, and I had traders that were listening that day, you know, about a decade ago, that were talking about that. Remember that day, because the day that I made an appointment with the guy, my gold dealer, was the day that it dropped like $60 intraday. And I'm like, that's great, on the day that I'm actually going to sell my physical stuff. So, but the reason why I point that out is because if gold hits new highs, you know, you just have to be really careful here based on what we're seeing, technically. So, you know, Steve, what do you think is going to happen with Russia here, going into today? Wait, before you answer that, I have to say one last thing. Stocks are beaten down. We have this big, you know, this
more
head and shoulder pattern.
Yeah,
I mean, this is all accelerated. Thank you by Russia. As of right now, you know, we're at 4150 or 4100. Sorry. If you look at you look at like us technically, we're below the 24% retracement of the long-term post-COVID move. We're at 127% extension of the last, or the shoulder, if you will. Daily sentiment index is at a very,
10.
very balmy 10 right now, which is
rarely see that.
You know, it's a pretty extreme negative sentiment number, which you have to be a little careful chasing markets down here. I'm not saying that you should be going long, but hell, if you're short, you got to be really paying attention to that. Anyway, and remember, we might be at a situation where if you think about Russia and Steve, I wanted to ask you about this, but if you think about like Russia playing its chess pieces, and doing what it's going to do to Ukraine, and maybe pulls off the gas a little bit, things settle down, deal with sanctions. Sanctions are obviously going to be put on. He doesn't think the West is going to do anything at all. So,
I think he's just prepared for it.
Hold on, but I just want to say, and maybe he pulls back some troops a little bit or stops some of the aggression just to try to get down some of the sanctions. We go into that mode where it's a couple of weeks of back and forth. Anyway, that's just some thoughts here. But what do you think about what happens with? Well, I guess I need to just finish my thought. That's why you have to be a little careful about chasing markets down here. But do keep in mind, we are breaking down, not just with the S&P. NASDAQ's down over 20%. And you take the German DAX, which is obviously getting absolutely creamed. 50% retracement now of the COVID move. All right, Steve, sorry about that. What do you think
No problem, mate. Listen, I won't lie, right? Would I expect Putin to, to take it all the way to where he has? To be frank, no. I thought this would be another operation, of pressuring, wanting to get a couple more territories, taking it the slow way, and then doing the same in a few years from now. But as it seems, he's gone completely uncontrollable. He obviously has a plan, right? I mean, you can say a lot of things about Putin, but I think that anybody that believes or claims that he's stupid, he doesn't know what he's talking about. So there is a plan.
Anybody thinks he's stupid.
Yeah, I mean, there is a plan. We don't know it, right? We can't know it, but it seems that he has already decided that he's not worried about any possible responses, because he doesn't believe that the possible responses will include war, obviously, right? Because he's not crazy. I don't think he would want to go into war with any of the big powers. But unfortunately, he's read the table correctly. He knows that NATO is weak and unwilling to do much. He knows that the US is not going to be involved, in my opinion, by the way, correctly so, right? The only thing I don't understand, if you want my personal comment as an outsider from the US, is why the US doesn't make it clear since the beginning, and this way you wouldn't be showing weakness. If I was a US president, what I would do in advance would be the following. Listen, I feel for the people of Ukraine or wherever else, but it's not the business of the US to get involved with wars in other continents. So no matter what Putin does, we're not going to go into war. We're going to sanction him. And, the American people and the American taxpayer is not liable to, and American life should not be lost to fight wars in other continents.
Yeah. But then that opens the door for China, right?
But the problem is the following, Blake. If you don't say that and you end up not acting as well, because we all get judged at in the end of the day by what we do, not what we say, right? So if you imply in essence that you would be willing to do something about it, but you end up doing nothing about it, let me reverse what you said. What does that show to China? At least if you say in advance that I don't draw my line there, I mean, I feel for them, but definitely not enough to get me involved in some kind of a war effort. At least you make it clear. And if tomorrow you have to say something different about China, they might think, something in the Ukraine situation, they said in advance that we're not willing to participate in any warfare there. But they're not saying the same here. So perhaps they mean business.
Yeah. Well, hey, Steve, I appreciate your thoughts. We got like less than a minute now of the show, and so it's going to be a very fluid situation. I think you guys got to be obviously on your toes. K-Man, did you have any last minute words regarding Russia? What you think here with the markets?
No, not really. I just saw that Taiwan says 9 Chinese planes entered their air defense base. So I think it's nice. The risk board game pieces are moving.
Yep.
That's my biggest fear. That now that they move that they've done Ukraine, they're going to move and save Asia.
Yep, and that's
it's like 1939 all over again with Japan and Germany. Only it's Russia and China.
Very likely.
Yeah.
Yeah, it's crazy, guys. So look. I was having this conversation with Dominic in our chat room late last night. I mean, all I wanted to do was just enjoy my evening and enjoy a workout. And it's like, damn, I kept walking back and forth between, whatever I was doing and my office. It was ridiculous. Anyway, but we were talking with Dominic, and he's like, hey man, I made some really good money, but I don't feel good about it. And I'm like, yeah, you can't, not in this type of situation. When markets go up and down, like when stocks go up and down, it's like, yeah, well, that's just part of the stock market, right? We trade the stock market as, it's an asset that's kind of moving around. We can profit off it as people are trying to buy it or sell it. But when it's a situation like this, and real lives are at stake, and people's livelihoods, I mean, literally cities and their livelihoods are at stake. I'm more happy just being hedged right now, where I don't have, and I'm trying to play a little bit of the optimism card, so I can feel better about, not being on the short side of all this mess. I know we're all capitalists and everything else, but
By the way, Blake, you notice that
this is a serious situation that it has a lot of people's lives at risk.
You've passed on your disease to Stelios, right? You were the one that when you were going away, things were going bananas. Now Stelios has a planned trip, and immediately things go bananas.
Good. I'm happy to pass off that mantle because whenever I'd go on a trip, like it was a planned trip, something like this would always happen. So anyway, hey guys, just want to mention, if you haven't checked out the Trader Funding Program, I'm going to put that link in the chat box. This is a great way for, we have we got a lot of people that are doing this now, to get involved and be funded in a larger trading account. You have to pay an assessment fee, but once you go through the assessment, everything's mapped out on here. You can actually watch a little video at the very bottom about it. You want to learn more about the Trader Funding Program, check it out. It's something that we just started offering a week and a half ago. Pretty excited about it. We actually have some people that are passing the assessment.
Exactly. Really Speaking of which, we're now having people that are passing the assessment.
Yeah, it's awesome. It's pretty amazing. Anyway, I also want to say, if you don't want to get your ForexAnalytix that way, because you do get ForexAnalytix with the Forex Trader. The funding program, the Trader Funding Program. You can also try ForexAnalytix for $1 for 10 days. You can kind of see where here's our chat rooms, right? You can kind of see what we do and kind of talk about all day long. Trades rooms where, we pull, put up what we're doing in the markets. You got the Forex Flow room, which is more of the macro chat room. And news and research, Spanish chat room, very active community. Probably, I would say it's probably one of the most active communities of active traders out there. So come join us. It'll be great. All right, Dale, it's all yours. Have a great interview. Thanks everybody for being here. I will see the rest of the ForexAnalytix people in 45 minutes. K-Man, always appreciate your thoughts. Same with you, Steve. We'll catch you guys.
Bye, everyone.
Have a great day.
Thank you, team. Peter, I'm promoting you now so that we could talk. Not sure. There we go. Welcome back to F.A.C.E, Peter. What a day to be here. How are you?
Can you hear me okay, Dale?
Got you now, Peter. How are you?
Okay, good. Sorry.
All right.
Yeah.
All right. What a day. You want to hit the green share screen?
Absolutely. Yeah, let's do that.
Get going.
Let's do that.
Yeah. So ruble new all-time high at one point today, wasn't it? All right. Let's start here. So I remember this NASDAQ, right? Yeah. So I remember your report in December about January, and you were looking for a correction, and then when we got to that low in a few weeks ago that everyone thought might be a bottom, you're calling that the end of That was 3, and then we had a 4 bounce, and now we're down. Is this 5, or we're just going to continue to wash out here?
Well, I think we probably are looking at some sort of 5-wave generic move down. I was just working some mathematical measurements here.
Yeah.
And seeing what prospect we had for later today and tomorrow. And overall, it does look as if we've got a generic 5-wave pattern downwards. I mean, there is some sort of unconventionality with this, because the 3rd wave for the NASDAQ looks as if it's subdivided into 3 waves, which is a bit of a red herring, if you understand that as a meaning for, a bit of a...
Yeah, 3 was 3 instead of 5.
Yeah, I mean, I've seen something like this, but inverted on an uptrend back in 1999, when the NASDAQ was actually in its last phase. It was within about 3 months of reaching the dot-com peak in early 2000. And the last 5-wave sequence up in the NASDAQ during that 99 advance was a conventional, what we call an expanding impulse pattern, where you get commonly, one of the waves, typically 3, expanding the price range. But the subdivisions in those impulse waves were 3s. And it in a way looks like that here. You've got a 3 swing down in wave 1, a 3 swing down in 3, and even a compilation of a 3 price swing, what we call a double zigzag in here. And it's a bit unusual, to be honest. If you look at the overall form without actually taking any notice of the subdivisions, then sure enough, you've got 1, 2, 3, no overlap in 4. And the 5th wave measurements are coming into completion at the moment.
Yeah.
So if you just take the generic form, it's okay. But I'm quite intrigued by the fact that it's folded and subdivided these impulse waves into 3s. That's very unusual, to be honest.
So could there be a possibility that this whole thing is going to end up being corrective, and the bull market continues in the face of the Fed and geo risk? What's your take? I know you just take it a day at a time, but would you be looking for getting long for a trade in the S&Ps or Dow or NASDAQ, any of them, in the coming days?
Yeah, I think we could probe a long positioning within the next couple of days or so.
Okay.
I think that we've got a little bit left to do on the downside here on the NASDAQ. And another good example, I mean, the S&P, ironically, and the Dow are not great examples for getting archetypal patterns out of the analysis at the moment, but one that's actually quite good, ironically, happens to be it's the Russell.
Okay.
The
weak sister for year. Yeah.
That's right. And if you take a look at the Russell, you can see that going back to that November high here, we've got another 5-wave sequence, except that this one is still about 4 or 5% off its low. That's a little bit worrying, because there's no obvious way that we could buy this at the moment. And if this is going to drop 4 or 5%, well, I mean, it could exaggerate to the downside and underperform. So that means, 2-3% down on the NASDAQ. That's possible. That is certainly possible. But this tells us not to be buying today.
What about a 5th wave failure on the Russell here?
Well, that would be okay if we could see a substructure in wave 5 here.
Yeah.
But at the moment, it's an incomplete sequence down. It's not. There's no visible 5-wave completion there. So it doesn't really evoke the idea that we could see a truncation or a stunted 5th wave. It's looking a little bit incomplete. So I know that there are quite a few divergences, aren't there? On an RSI, for example, if you pulled that up, you would see some divergence. Typically, we see that between the 3rd and the 5th waves. But it just doesn't look quite ready, does it? It basis this Russell. It looks like it needs a little bit more to the downside.
Well, I think a lot of people are focused on Russia-centric markets, which of course means crude, precious metals. And I know you were looking for a new high in the dollar, new low in euro, which it looks like we're on our way to that. And I don't think you were expecting new historical highs in the ruble, but it's leaving quite a tail today. But the gold move was spectacular. I mean, you can't buy. Can you buy gold? Just chase it, and I felt like that $100 ago.
Yeah, I mean, I must admit that I thought the gold might pull back first. I mean, it's been a rather sort of defragmented sort of advance on gold in this latest run. But I have to admit that I was wrong in the very short term there. I thought that we would get some sort of pullback before this next push up. But looking at it, it looks like it's already running. And that means a revisit back to sort of I think back to the 2080 high up here. This is how I think it's probably going to look now. I was hoping it would pull back and stay below 1877 originally, but this thing's far too powerful, and I think, it looks like it's going. The thing is that silver should outperform. It's been lagging in the last couple of weeks, and it's only really this week that it's starting to get some momentum going. So silver, I think, is probably better to buy than gold, because gold's pattern up from these lows is very fragmented and very overlapping. It's not great. But silver, you've got a fairly clean, concise movement. Now that silver's broken today, sort of above some key resistance levels. And I think that's leaving behind this overall correction and starting to trend up. So that means, we could be looking at $37. That was the original idea anyway. So I think if I wanted exposure in precious metals, I'd prefer to buy silver.
Okay, 2050 off the table.
I don't think we can expect that now, because we've broken this 2478 number, and even today I think this 2545 is even more important. So I don't think we can expect 2060 anymore. I think today was a critical day today to show that this thing is already in its transient next move up.
Okay. All right, and oil. What kind of count could you have in oil with this blow off today?
Yeah,
you have a revised count on it.
Let's have a look at Brent, because it's 3101. I was looking at this earlier this morning. This is Brent oil. This is the move up from December. See, the thing is that Brent oil and crude oil, they're unlikely to. They have the same rhythm as the 10-year Treasury yield, and we've got some pretty good forecasts on 10-year Treasuries, 5 years, 30 years. They all look as if they've topped out last week, and they're starting a new trend to the downside. Now, of course, that tells us that dollar yen shouldn't be too far behind turning down. It also tells us that oil shouldn't be too far behind turning down, because oil is basically the inflation trade, really. If you want to trade on rising inflation pressures, you buy crude oil, or you buy one of the energy markets. If you think that inflation pressures will pause at some point, you've got to be thinking about where oil is going to top out. So the last time that 10-year Treasuries moved up was December. We were at 170 then. And this has moved up since to 206%. And we've got here a Brent oil moving up in a 5-wave pattern. Now, I've applied a 61.8 correlation ratio. That's 1 to 3 times 61.8 equals 5. And it produces this 103 number, 102.92. So I'm quite keen to see how that gets on today, because I think if that tops out, then we're definitely starting to look at a major peak here. And that means calling the entire 5-wave advance from the pandemic lows as approaching this completion. So I can't see why oil in any way or form would be continuing this same velocity to the upside. I don't see why it would do that.
Okay. So since the Dixie, what are we, a stone's throw away from some of the targets you had in Dixie and Euro, and seems like Aussie's been more resilient, but it's under pressure here. So do you think that maybe this last push up in the dollar might create some type of pullback in the metals, or it doesn't matter? They're both going up together.
Well, I mean, the dollar should be finishing its sequence. This should be the last sequence of all. I mean, the noticeable thing here was that this time last year, we had upside targets to about 95.80. That was originally the 50% retracement of the pandemic downswing from 102.99 to 89.21. And this was always considered to be a corrective pattern, which it is, except that the final fifth leg of this wave C of the secondary zigzag goes back to September here, 91.95. I mean, that's evolving in 5 waves, and the fifth wave from January's low should have unfolded to a higher high in 5 waves, and we only detected 3 at the time. So when that sharp drop occurred late January, early February, we then started to work with this diagonal pattern, because 3 waves up cannot complete this sequence. It has to be a 5-wave subdivision. Well, we can augment a 5-wave subdivision if this is a diagonal. And that would certainly comply with the idea that this is a zigzag for the first wave of that ending type diagonal. So, and sure enough, the dollar's pushing up. So there's no doubt in my mind that once we get up to 98 in this sequence, and it might take another couple of weeks or more, because we've got to have a 4th wave pullback at some point, maybe in 2 or 3 weeks, that this will be finishing. But there's a bit of a disconnect, isn't there, in terms of amplitude with these, because, okay, we've got gold and oil now breaking overhead resistance. So they're trending up whilst the dollar's pushing up. Whereas before, the main driver for gold and silver was really sort of what the dollar was doing. If it was moving up, gold and silver would edge lower. If the dollar was in a correction, then it would give a boost for the precious metals. But that's, we're completely disengaged now. So it looks like if this dollar is going to head up and finish 98 figure or thereabouts within the next few weeks, and then starts a massive decline, which I think it will have to, then that's going to be an even bigger boost for precious metals on the upside. And I don't think it necessarily means I don't think it necessarily means that is good for things like copper or some of the base metals, because they look very top heavy already. I think they're on their way down, actually.
Or oil?
Yeah, I think oil you see as an inflation trade. So if we're going to predict stock markets continuing lower over the next months, which is what we originally had at the beginning of this year, right, and you get that's going to cause inflation pressures, then you're also going to see oil drop, aren't you? Because that's the inflation trade at the moment. So that oil price will have to come lower if bond yields are going down, if stock markets are going down. At some stage, that disconnect will have to change, and you're going to have to see oil go down on the basis that we're seeing a bit of a contraction in the growth of the economies around the world.
Okay. Yeah, so really it's almost like the markets have become, was all one market, and you're right, it was dollar centric, and we've decoupled from this. I'm wondering with your forecast on yields, and it was a great one, got up to there and turned, I don't know, maybe there's another push. I'm wondering, while the Fed, your forecast is basically saying we could pull back on the 10-year to, okay, there it is. Yeah. While the Fed's in a hiking cycle, I just have a hard time understanding. All right, so the market already has priced in everything the Fed's going to do, and yields are going to be cut in half while they're hiking, or are they going to pause because of the geo risk in the markets and things? Are they going to flip the switch and hold off?
Yeah, I don't think. I think that probably. I always thought that they were going to front load by 50 basis points even before the market talked about that. I just realised that the Fed were panicking, and that they might even front load, and that's come into the mainstream discussion at the moment. Obviously, if
so
yields
you wait for the Fed in mid-March and then buy bonds.
Well, I think I've already got all of our clients, about 50% of our client book is actually trading fixed income yields, and we're long T-notes and bunds in a big way. Actually, quite committed to that. The clients and I think the outlooks look really great. I think the narrative has got to change. I mean, I know the focus is on Russia, Ukraine at the moment, but I think the narrative has to go back to Fed tightening at some point. That's going to be bearish for stock markets anyway. That's basically going to mean that we're going to start thinking about commodity prices coming down, a pause in the inflation pop. So inflation pressures start to ease off. And I think generically, yields will start to turn down because the economy is going to contract a little bit. So I think the narrative is going to switch around a bit. I mean, let's face it this way. If you've got a war in Europe, which there is now, wouldn't you think these yields would be declining far faster than they actually are? I would have thought so.
Yeah, if central banks had not started the narrative, and not only the narrative, acting on it. Didn't the Royal Bank of New Zealand raise rates, or was it Australia this week, and BOE a couple times already? Yeah. So we're already in. If we weren't in that cycle, I could see this chart, but it's almost a Rod Serling correlation. It's a twilight zone correlation now.
It is, and I just when I look at this, I'm thinking, okay, yeah, we've got Russia, Ukraine at the moment, but I think the narrative, I think the bond markets are looking at that and they're saying, well, we can't buy T-notes and T-bonds at the moment in big size. I don't think the market's generally aware that there's a turn around, which I'm depicting here, that this entire movement up from the pandemic low is a 3-wave zigzag, and this 5-wave advance from the August 20 low is finishing. I don't think the market's not aware of that. What they're thinking about is still tightening. So in that context, they're not even buying bonds because of the war situation on a safe haven basis. I think ultimately, if the Fed go ahead and hike 50 basis points, it wouldn't surprise me at all. Then they suddenly back off. And say, well, we're going to review things. That is a bit forward thinking. That's giving a lot of credibility to the Fed, and I don't give them much because I think they're so behind in their projections forward out that they could look at yesterday's paper and never get it right. So I just don't think that they're probably going to say that. But I think the market will adjust in time. I think we're going to see a pause in the inflation pop. And I can't see why oil would hold up for too long in that environment either.
And part of this could be also risk off, because I know you have lower targets for this huge wave 4 correction. If you want to share your longer view on S&Ps, perhaps that's also the catalyst for yields to come in.
Well, that's it, because originally
in fact, that's what you told me. You said we had a talk, and you go, well, what else could bring rates down? And that's before the market topped. And so you were saying if your interest rate scenario was correct, that it most likely meant a risk-off move in equities. That was well before Russia came on the scene.
Yeah. No, absolutely. And the reason behind that is this is the S&P daily chart from the pandemic low. And I've always maintained that this is a 3 price swing event. And if it is, we can try and prove that. If we extend this by 61.8, here's the projection where the C wave should end, and it started here at 3,200. So that deviation is negligible. So that's good enough proof that we've got what's called a zigzag in Elliott wave terminology. This zigzag was 3 price swing event, and the only way that can begin a new uptrend, a zigzag, is if it's part of a diagonal, which is this idea, where the diagonal is a sort of a wedge-shaped 5-wave pattern, 1, 2, 3, 4, 5. And of course, in order to get the wedge shape correct, because this is the component wave, atypical of an ending type diagonal. This is the 5th wave, so it's ending the trend, which began back here from the financial crisis lows. Yeah. And that is as a standard prerequisite, you need a 76% adjustment to the downside. And that's why we've got this huge downside target for this year. And we've been basically talking about that for several months.
Yeah, check out Peter's video. Also, at the beginning, it looks like you were looking for a rally maybe back towards 4,700. Is that off the table before the next big decline? Or are we in that spot now at this 4,100 level that we get that bear market rally before another big break, instead of people just chasing gamma and whatever they're doing, these new Greek words that, specialists are doing. Perhaps there's going to be a much better level to sell at than down here.
Well, I was previously thinking that we had a chance of a nice sort of 6-7% rally, but I'm not sure that we're going to get it now that we've added to the declines today. I think we might still get 4 or 5%, but not maybe 6-7. And I showed you at the beginning today the Russell and the NASDAQ chart under the microscope. I think the picture here, let me see. Yeah, I mean, I think we have got a 5-wave pattern if we're going to replicate the NASDAQ down. So we're going to get some sort of rally. But I was taking a look at the one joker that's basically pulled out of the pack that doesn't really make sense much for a rally of more than 5% is really the DAX. You see here in Germany, the Xetra DAX, I mean, the pattern looks really bad. I mean, it looks very bearish. And I'm not sure we're going to get more than 4 or 5% out of that. The way its construct is working. So I think 5% is probably about what we should be hoping for if we can get another selling point before we come down again. But the DAX is really, it doesn't really look great. And because of that, we're sort of paring down the Russell sort of like rally after we get down here. If we can get down here in the next day or two. I think the rally normally in Elliott wave, you would return back to wave 4 preceding, which in this case would be about a 50% retracement, if I'm not mistaken. Let's just measure it down here. Yeah, 50%. But you see, the problem with that is that that's too big a percentage move. I think it's probably only going to do 38%, which is a sort of a basic minimum requirement, which is somewhere up here, 2020. But even that is, that if it moves up from 1790 to 2020, where are we doing about 1790%? That's 12%. Even that's quite big relative to what the DAX can do. So I'm not sure it's going to be doing something like that. It's a bit tricky at the moment to evaluate that, but well,
tricky is a great word. I mean, look, we haven't experienced anything like this for, I don't know, 80 years. So, only our dads remember what it was like to trade.
That's a little bit of an exaggeration, I think.
80 years? Okay, well, I think
no, I mean, you can't compare what happened 80 years ago to what is happening, at least for the time being.
Not yet. I mean, look, the Sudetenland was all Hitler wanted. I rest my case.
Hi, Peter, by the way.
Okay. Anyway, so Peter, great stuff. I really appreciate on a high stress day where I know, a lot of people are depending upon you, your subscribers, that you took the time out to come and talk to us.
No, thanks, Dale.
I know it's not, I know what it's like to have heat and, markets that are, exponentially like 8.0 Richter scale stuff happening in the markets. So really appreciate you being able to have the composure to do an interview with me today.
No, thanks,
and
Dale.
For our community.
Thank you very much.
And I just go ahead.
Yeah, I was just going to say that anybody listening in, just be safe, be careful. I mean, watch out for these numbers. Don't overstretch, and if at all, and you're not sure, don't trade. We're trying to piece together things as much as we can. And, we'll be publishing our report tomorrow night. Hopefully we'll have something concrete to show everybody.
How do they reach you, Peter?
As always, you can go on to have a look at wavetrack.com. Thanks for that. This is wavetrack.com. Just go here.
Oh, look, you're a subscriber.
I
see your name in there. You must subscribe to the service.
Where's my name? Peter. Oh, here. This is my password. Yeah. Yeah.
Anyway,
I find it quite useful.
I'm glad you subscribed to your service.
Yeah, no, good. Yeah, I do. Yeah, who wouldn't eat their own food if you're a chef? And okay, and you can click on subscriptions, and if anybody wants to tune in, we'll be publishing another update tomorrow night, the Elliott Wave Compass, and you can just click on here and add to and go through the subscription thing. So yeah, thanks very much. That would be great. We'll get there. I think we'll have something concise pulled together. We're working on it through today. We've been up all night. We've had 4 hours sleep in 24. We're committed to try and find the answers for everybody. So stay tuned.
All right, Peter. Thank you, my trading warrior. Thank you, my trading warrior brother.
Thanks. Nice to hear your voice, Steve.
Yeah, nice to hear you as always, mate.
Great interview, Laura.
Okay.
You're welcome.
All the best.
All right. Adios. We'll see everyone tomorrow. Remember, don't just count your pips, your blessings, and on fire. Everything being different ways. Join the team. Edge, and we'll see everyone tomorrow. Hope for peace. Thank you, Paul.